Everybody, it's Chris with Life 180, and for this video, I want to talk to you about the 5 levers that life insurance companies use to manipulate the internal performance of an index universal life policy. Now, before I get into this, what I want to kind of get out of the way and talk about is the fact that out of the 5 things I'm going to talk about, and the 5 levers that are moved, some of them are more relevant than others. Some of them are going to have bigger impacts than others, obviously. And also some of the levers you're not even able to really show on the illustration. And that's one of the scariest parts about this whole deal, is because there's such a lack of transparency with an index universal life illustration into what your expectations are that I think it's borderline dangerous. No, I think it's just straight up dangerous. And so, at the end of the day, what I want to do today is go through this video and talk about the 5 levers that life insurance companies use to kind of manipulate the performance and how that impacts you and what you can do about it. And if you're a life agent looking to sell this, my mission here, my hope is that you see this and you understand this, because most IUL agents don't fully understand how these levers are able to be manipulated. Most people have been in the industry for a very short period of time. They've never had policies had to be renewed and actually do annual kind of check-ins with their clients and see, look at the in-force illustrations and kind of see what's going on. And they haven't seen a lot of the negativity that I've seen over the past decade in these policies. And so my hope is that you'll see these, that you'll understand that they're not in there by accident. Life insurance companies allow the flexibility for them to manipulate their charges and their fees inside of the policy and utilize these levers to do this, because they created Index Universal Life as a way to offset risk from the insurance company to the insured, whereas whole life, the insurance company takes on all the risk. And obviously when you do that, it's, from a consumer perspective, as an insured who's buying the policy, it's a lot more predictable, it's a lot more guaranteed. You can use it as a banking alternative. You can take your risk outside of the policy by accessing and utilizing the policy as leverage, collateral, to be able to get those outside assets working for you. That's where you get your returns. And with an IUL, you can't do that. And so that is what it is. So let's get into this. So the first lever that I want to talk about is administrative charges. Now, this is one of the lesser important elements as far as the levers that they use. But the bottom line is everything adds up. And I think as we go through this, you're going to see it. But administrative charges, a lot of these IUL contracts allow for the administrative charges to be raised, to a specific, within a specific range. And so, while it may not be a huge number, it does add up. Every penny counts. And when I get into some of these later levers, you're going to see how, when you take a couple extra dollars out of these policies every year, couple $100 a year out of the policy, it really starts to negatively impact. The compounding works in a negative way, because the illustration of the policy assumes that money's going to be there. And if you understand the cost of insurance inside of an IUL is the net amount at risk. So for every dollar that you assume to have in the policy based on the illustration that you take out based on increasing charges, the net amount at risk is increased. And so therefore the cost of insurance actually goes up compared to what the illustration is showing. And so that can have a real negative impact. So that's the first thing. Now, the second one that I want to talk about, the second lever that I think is really important to understand, is actually the cost of insurance. Now, I know some companies have changed this and they've made it so they've guaranteed that the cost of insurance won't go up. But here's the one thing to understand. A lot of life insurance agents that sell Index Universal Life, you have to understand there are 2 different ways ultimately to strategize and kind of structure an Index Universal Life policy. You can do an increasing death benefit, or you can do a level death benefit. So option 1 or option A is a level death benefit. Option B is an increasing death benefit. And so if you look at why you would want to do one or the other, a level death benefit is going to keep it so any of the cash value that's going into there is ultimately eating into the net amount at risk in the insurance policy, right? So if you have a $500,000 death benefit and you're putting $10,000 a year in, and let's say the cash accumulation in the first year is like $5,000, well, now you have the net amount at risk is the $500,000 minus the $5,000 cash. So you got $495,000 net amount at risk. And so now your insurance charges are based on that $495,000. that's great, and that, you know, there's value there. But the bottom line is IUL works as like an annual renewable term. So whatever age you are, your insurance cost is going to be charged based on your current age. Yes, you lock in your insurability, but the cost of insurance as you age, when you get into your 60s and 70s, gets very expensive. That's just the way it is. So if you're in a level death benefit, the idea is you're going to close the gap on that net amount at risk, so you're going to have less need for insurance. But the bottom line is that's not what most life insurance agents do, because if you're trying to generate this and make it look amazing on an illustration, your goal is to do the minimum death benefit, the maximum accumulation of cash. That means you want to be able to put as much cash into this policy as possible. I'm speaking like an agent right now. And if you want to add in as much cash as possible, the only way to do that is to do option B, increasing death benefit. What that does is it makes it so the amount of insurance goes up every year. So because of the MEC tests and with all the rules that go along with that, you're allowed to put more cash in every single year with an increasing death benefit. And so whereas maybe with a level death benefit, just for argument's sake, if you were to put $10,000 a year in, you know, the death benefit might be able to be 500 grand, and it's going to be level. Where if you do option B, that 500 grand is going to go up every year, and instead of maxing out at $10,000 for a premium, that might go up to $15,000 or $20,000 a year for a premium that you're allowed to pay in. It's going to make more money liquid, but the net amount at risk isn't going to get much better. It's going to constantly be getting you more insurance, and so the insurance charges are going to continue to rise, and so that's important to understand. So while the insurance company may guarantee that your insurability is going to remain the same and they're not going to change the insurance tables on you, what they're not going to do is guarantee that you're going to be locked in at a low insurance charge every single year. If you choose option B, it'll let you get more insurance into the policy. However, your insurance charges every single year are going to become more expensive, simply because as we get older, insurance costs more. So when you get into your 60s or 70s, even 80s, you know, if you're using it for retirement income, that's where these things really run into trouble. They illustrate really well, and I'll get into that after in some of the next levers that we're talking about, because I think it's really relevant. The third lever that insurance companies use to manipulate internal performance of your IUL is rider charges. Now, there are all sorts of riders. I'm not going to take the time to go through rider after rider after rider. Every company has different riders, different multipliers. They all work differently, and they all have different moving parts that they can manipulate based on different market environments. And most of them, not all of them, but most of them are not guaranteed. So if you're using multipliers, if you're using riders or anything inside of a policy, it's important to understand how those riders work, how the company has the ability to kind of set these moving targets on the riders, and you know, where the levers in those riders are, what triggers them, what the costs are, what the fees are, how you take advantage of the riders, because the only reason you're going to want to get a rider is because of a benefit that ultimately comes to you. A lot of people, just as an example, think that an accelerated benefit rider, if you become critically, chronically, or terminally ill, like they think that there's no charges to those because you don't have to pay for it on the front end. But the bottom line is there are charges to them. You get charged when you utilize them. And a lot of times it seems like, okay, no big deal, I'm only paying for them when I use them. But at the end of the day, you know, there are fees to utilizing that specific rider. Now, there are a lot of other riders that work a lot differently. It's important to go through line by line in the illustration and understand how those work. All right, so the fourth lever that I want to talk about is cap rates. Now, this is one of my favorite ones to talk about because it seems to rile up the most people, because everybody's like, oh, cap rates don't go down. Well, guess what? They do. They always do. They always will. Here's the bottom line. Insurance companies use high cap rates to buy business. It's like a marketing expense. It's part of the game for the life insurance company. So if they start off by saying, hey, guess what? The cap rate is X percent. Let's say it's 11%. Well, guess what? They're utilizing that 11% cap rate to be attractive in the market. They're going to have it run for a certain window of time, and then that product is going to become a secondary product. They're going to create a new product with a new high-end cap rate, and they're going to use that product to buy new business. And when the first generation product gives way to the new second generation product, that cap rate on the first generation product will be reduced. And when that cap rate is reduced, listen, most of these cap rates, if they're a current rate of 11, the insurance company has the ability to reduce that cap rate all the way down to 3%. How is your policy going to perform if the max you can earn on it is 3%? In fact, I don't know if you realize this, most cap rates, if your cap rate goes from 11 to 8%, it makes it almost impossible for your policy to even average 4.5%, right? Like, so you have to look at the numbers and really understand all the moving parts. A lot of people think cap rates are not going to be reduced or that they don't get reduced. People who say that run in-force illustrations. I've been looking at so many illustrations. I've been looking at, what the current cap rates are. I had people send me illustrations last week and be like, hey, can you help me look at this in-force illustration from a couple years ago? It was sold at a 12% cap rate. The cap rate's down to 8.75% already. This is like 4 years after the fact. So if you look at that and you take that into consideration, it's mind-blowing that people are not seeing this. And I'm really torn at the agents that say this isn't happening, because I've yet to see a policy that's 6 years old. And if anybody's out there and you have a policy that's more than 6 years old, send me an in-force illustration, black out all the personal information, I don't care. But I've yet to have somebody be able to follow up and send me an in-force illustration 6 years old or more with a cap rate being what the cap rate was when they marketed the product for sale in the first place. And so this is a big deal. If this is one of the biggest deals that impact the actual potential growth of the policy. And so it's the number one way that insurance companies, actually probably one of the top two ways, is probably tied with the other way that I'm going to talk to, the other lever that I'm going to talk to about number 5. But it's one of the top ways that they really manipulate the performance of your policy. It's one of the top reasons that your illustration that you receive from your agent will never perform like they showed it to you. You get these people that are showing 7% illustrations, 6.4% illustrations, they're never going to meet those numbers. I promise you, it is what it is. It's almost criminal, in my opinion, that they're doing that, because I'm a big believer. It's expectation of what we're gonna be getting out of our financial strategy is really important. It's not necessarily that these policies, if you max fund them and you structure them properly, it's not that they're going to implode or lapse or blow up on you. They may, but the bottom line is I don't think they're necessarily going to. But if you're expecting to put $10,000 a year in and then 30 years later have over $500,000 in an account, but then you end up with around $300,000, like, that's a big deal. That can have a huge impact on your retirement, on what you're doing. So I'm a big believer, like, there's no such thing as bad products. There's bad salesmanship of those products, and there's bad expectation, right? And there's a lack of education. And so that's what I'm talking about. If you can run an IUL at a 4%, 4.5% assumed rate for an illustration, then I think you can, even though it's not going to be guaranteed, I think you can look at the risks involved with it. And if you can live with the downside of that, and you can say, okay, I think conservatively, I'm comfortable with the risk involved in this policy. Maybe there's a little more upside, so I'll be okay with that. Then you go with that. But at the end of the day, the cap rate manipulation is a huge thing. And that leads me to number 5, and this is one of the most confusing ones, but it's the loan rates and the ability for the insurance company to manipulate loan rates. Now, here's the deal. I'm gonna actually go into this. I'm gonna show an illustration. And I want to show a couple things in an illustration that kind of show what's going on here. Let me pull this up. I did this wrong. So there we go. Here we go. I'm going to figure this out. There we go. So here's the deal. This is just an illustration example, and just to kind of show you here, this is how strong insurance companies are about making sure you're clear on this, because the bottom line is they build in arbitrage into these loan rates. Into the way that illustrations are run. Actually, let me come up here. I'm going to get up here to show you. I got to get to the right place. This is the accelerated benefit riders to talk about how those. It's a surrender period. This is explaining all the terms. Here are the loan rates. So alternative policy. This is what most people are running the loan rates as, because it looks better. It illustrates better. So if you, even in the fixed rate, right, when you look at the credited interest rate policy, like you're talking about, or the declared interest rate, I'm sorry, this one right here. This is the fixed rate where they're saying they're gonna give you a guaranteed low percentage rate loan, which is 3.9. but they're basically you're going to get credited with a positive arbitrage or like a wash. They're going to build that in. They actually build in the 0.9% because what's going to happen here is they show a 3% after year 11. They're saying you're going to get a reduction in the charges for the loan rate. They're never going to do that, first of all. But this is what most people are doing, is they're using alternative policy loans. This is basically a variable loan because the cost of the loans can change. And so the current rate that they're doing is 5%. The illustrated rate is 5%, and the max that they can go to is 8%. So what I know to be true is these rates always change, and they always go up over the long period of time. Well, I shouldn't say they always go up. I guess that's not completely accurate. They have come down a little bit, maybe in times like we've been in this low interest rate environment. They've come down. But the bottom line is when you look at the combination between the cap rate manipulation and the loan rate manipulation, it's a really, really dangerous thing because you're not able to illustrate and have complete clarity on what your policy is going to do. And so between the two, it's super dangerous. And where this gets really impactful in the negative performance compared to what in the policy and how it's going to perform compared to what you look at on the illustration, where this gets really negative is they're building in this 5% here. And if you look right here, this is the illustration includes an alternative loan for which an accumulation value remains allocated to the interest strategy selected and continues to earn an assumed credited interest rate. Index Universal Life illustration regulations require that the maximum assumed interest credited to the accumulated value in an alternative loan illustration is equal to the lesser of the illustrated rate or the loan interest charge, currently 5%, plus 0.5%, so 50 basis points. So what does that mean in plain English? That means if I am showing you on the illustration that you're earning 5%, I'm banking in the fact that I'm going to be able to show you and illustrate you it's going to basically illustrate a guaranteed 50 basis points positive arbitrage. That may not seem like a big deal, but it's a huge deal because it's saying that as you borrow money, it's building in positive arbitrage. Now, let me go down here. Understand that and get down to this point in time. I'm going to get down to this place right here. Okay, so then we go down here and you have to sign on this. I've received and signed a copy of the illustration. Understand that any non-guaranteed elements illustrated are subject to change and could be higher, either higher or lower. The sales representative has told me that they are not guaranteed. I requested illustration of one or more alternative loans and understand that while the alternative loan has a potential to credit interest at a higher rate than the corresponding loan interest rate charged, loan interest charge rate, there is also a significant risk that alternative loan interest credited will be substantially less than the corresponding loan interest charged rate, right? Which I understand significantly increases the risk that I may be required to pay additional premium or make loan repayments to meet goals and or prevent the policy from lapsing. I also understand that this illustration is not a contract and the terms of the policy constitute that the actual agreement of coverage. So what this says is up there, up top, when I just showed you, what it's saying, I'm going to switch this over. What it's saying is that the illustration is showing a guaranteed arbitrage of positive 50 basis points, 0.5%. And then right there, it goes to show you like it could be higher or lower. Where it gets dangerous is that if the loan rate remains 5 and the cap rate comes down and then the policy performs negatively, in any like bad years, even in the positive years, you're not able to build in that arbitrage in a positive way, in a positive enough way to make up the difference. And so what happens is compounding works against you, right? Because the cost of your insurance as you get older, especially if you did option B, which most people do who really jam money into these things because they make it seem awesome and it illustrates beautifully because you build in that positive arbitrage. But when you get to retirement, what happens? That's when your cost of insurance is highest. That's when you're typically taking loans out of these things or against these policies and leveraging them for retirement income. But then what happens is that loan never goes away. That loan balance just stacks and stacks and builds and builds. So if your interest rate goes up, and it's a variable interest rate, so it could go from 5% when you first start to 8%, your expenses get more and more and more expensive. They compound against each other. And then if you have a negative year or a flat year in your policy and you have an 8%, that's an 8% charge. You didn't just get protected on the downside of your policy in retirement. If you have a loan balance, you have a 0% performance. You're still taking income, is my guess, because you need it. That's why you had the policy. Plus, you have an extra 8% fee if the loan rate is there. That's going to be pulling out of your account value. So it's going to be pulling the amount of cash value that you have in your policy down, increasing your net amount at risk, net insurance, at risk. And so your insurance charges are going to be higher. And these are where these things just steamroll out of control. They snowball and they just implode. I'm telling you, this is when you look at these as investment alternatives, these are why people like Doug Andrew have gotten involved with class action lawsuits of 66,000 people going after him because their policies didn't perform in the right way. These things never perform according to illustration. You got people like Curtis Ray who are out there touting. I mean, he's touting, even right now, you go to TikTok, Curtis Ray is touting 6.4%. 6.4%, he's illustrating his Mutual of Omaha policies. And guess what? I was just on the Mutual of Omaha software the other day looking at exactly the policy that Curtis Ray is selling, and you can't even illustrate them at over 6.2% anymore. They've already reduced their expectations, but he's got these calculators and he's selling this at 6.4 as the assumed rate. What happens when they reduce their cap rates and they reduce the requirements that they have to illustrate lower? These things are not going to perform. The charges go up. Everything compounds in a negative way against you. If you're against 401ks, if you're against IRAs, if you're concerned about increasing tax environments and inflation and, being in business with the government and them controlling, it's no different here. If you're with an IUL, you're basically in business with the insurance company, and their job is to take care of their either their stockholders or their mutual policy holders. And so if that's the case, if you have an IUL with a mutual company, you're never going to separate the returns of the general fund from the dividend rate, from what they're paying their mutual policy holders, right? If you have an IUL with a company like a National Life Group or an IUL with Penn Life, and they have IULs, or with Guardian, and they have IULs, and you have a whole life policy, their IULs are performing really, or tied to an index, and it's looking really well. At the end of the day, if their dividends are struggling with any of those companies and they go to pay in, or they have to go pay their dividends because they're struggling, they're going to pull out from the IUL pool. If it's performing as well as everybody says, they're going to reduce the performance there to recapture costs, to cover the dividends, and go from there. They have to take care of their guarantees first. They're an insurance company. That's what they're in the business of doing. Now, if they're a stock company and not a mutual company, what is the insurance company's first responsibility? Yes, the general fund works the same amount or the same way, but their first responsibility is to, like any stock company, is to the shareholders, not to you, the policyholder. So if their general account isn't performing, and they're not, which none of them are right now because of the fixed rate environment that we're in being so poor, so low on the return side, if it's not performing, they have to do what they have to do to get the returns to the shareholders. So they're going to, once again, do the same thing, pull down the returns, reduce the cap rates, increase the charges, get the returns to where they need for their shareholders, and go from there. And so at the end of the day, you are never going to be able to separate the performance of an IUL from the general fund because they have needs that they have to meet, and they have basic benchmarks that they're trying to meet inside of these general accounts. And those benchmarks are based on the fixed environment. And the reality is right now, the fixed environment kind of sucks. And so, if it gets better, that means interest rates are going to go up. And if interest rates go up, will that do well for the fixed rate environment? Sure. But when interest rates go up, it means the stock market struggles. And when the stock market struggles, IULs, it doesn't matter what the caps are, they're not going to perform very well because they're going to have a lot of negative or flat years without a lot of big years in that process. So you'll see a 4 to 5 to 6 year window where they don't perform very well. That's all fine and good if you're young and you have time to build it back. But if you're looking to do anything with retirement, and we have these cycles, maybe we have a 4 or 5 year period right now when it's where it's not where it's maybe bad and it doesn't impact you negatively because you're 30. And maybe 30 years from now, you have the same kind of situation where you have a 6 year negative period. But at that point in time, you're pulling money out. You're using the loan as collateral and getting income out of it. And then you have a bad 6 year window at that point in time. That's when it becomes catastrophic. So there's so many elements of this that are unpredictable, that are out of your control. And I'm a big believer you should never invest in anything that you can't control, that you don't at least have direct control in the results of the outcome. And that's one of the reasons I can't stand Index Universal Life for the purposes that most people sell it. There are use cases where Index Universal Life can make sense and the flexibility can be beneficial, but I've also seen the flexibility of an Index Universal Life be very detrimental to people, because just because the flexibility exists doesn't mean you can take advantage of it without hurting the performance of the policy to such a negative level that it doesn't implode. So anyway, I hope that helps. Those are the 5 levers that life insurance companies use most commonly to manipulate the performance in the policies. And if you have any questions, go ahead and comment below. If you haven't already, if you found value in this, please hit that like button. Really appreciate it. YouTube really loves it. I'm really trying to get some information out there to the world, to the insurance community. If you're a life insurance agent, if you have questions about this, you can feel free to reach out to me. I am on a mission to educate life insurance agents about this stuff. If you're curious about whole life, if you're interested in learning how to do this the right way, that is what I'm doing right now. Reach out to me. I'm happy to help people. I've got all sorts of different programs and ways that I can help you build your business in a way that I think will be extremely beneficial. If you haven't already, please hit the subscribe button, click the bell, that way you get notified every single time I launch a new video. And until next time, I hope you have a blessed, inspirational day, and we'll talk to you then. See ya.